Hi, stock markets have an uncanny ability to surprise. The ongoing bull run has surprised even the incorrigible optimists. As I speak to you in early August, the Nifty is up by more than 100% from the low levels of March 2020. The broader market, the mid and small cap indices have outperformed the Nifty. Investors are sitting on handsome profits. The relevant question is, where do we go from here? What should be the appropriate investment strategy? It is important to understand the nature of this bull run. This is a global bull market rally, except a few countries like China, Japan, Hong Kong, Malaysia, Philippines, Peru, few countries. The rest of the countries are experiencing a global bull run, a massive bull run. The mother market US, in the mother market US, the Dow Jones, the Nasdaq, the S&P 500 and the Russell 2000 has been setting record after records. Europe is doing exceedingly well. India has been an outperformer. India is outperforming the rest of Asia. Now, it is important to understand the factors driving this rally. What are the factors driving this bull market? Perhaps the most important factor driving this global bull market is the unprecedented, humongous liquidity that has been injected into the global financial system. The developed countries of the world, the OECD countries alone, have injected $13 trillion through monetary and fiscal stimulus. $13 trillion is a huge amount of money. This huge money that has been injected into the global financial system has been chasing assets like stocks, and therefore we have this unprecedented asset price inflation. In ordinary man's language, the assets like stocks going up. A direct consequence of this huge liquidity is the sharp decline in interest rates. Interest rates globally are at record lows. Even in the US, the 10-year yield is around 1.2% as I speak. In Europe, in many countries, it is close to zero, even negative. The real return on fixed income, therefore, is negative or very, very low. And disillusioned with this very low, abysmally low interest rates or return on fixed income, investors are chasing stocks which have been giving excellent returns. Another important factor is the rising power of the retail investors. Retail investors now have become a force to reckon with. In India, during the last 1 year, I'm talking about the calendar year, fiscal year 2021, 1.42 crore retail accounts, demat accounts have been added. And the retail investors now account for 45% of cash market transactions. So at every dip, retail investors are buying. Perhaps this may be irrational exuberance, but then this buy on dips by retail investors is imparting a lot of resilience to the markets. Also, it is important to understand that there is fundamental support to the bull market. Fundamentals have improved. In India, during the last year, FY21, the GDP contracted by 7.3%, but corporate earnings expanded by 14%. This is something very interesting. When GDP is contracting, corporate earnings are improving because the corporate sector is doing well. The problem is in the MSME segment. The stock market represents the corporate sector. So this year also, some 30 to 35% corporate earnings are possible. This is the fundamental support to the market, but the market has already discounted this fundamental improvement and perhaps more. Now let us look at the valuations. If you look at the valuations in the mother market US, the so-called Buffett indicator, market cap to GDP, which Warren Buffett regards is the most important indicator, that is around 205% in the US now, way ahead of the long-term average. The S&P 500 PE multiple, price earning ratio, is close to 45. It is frighteningly higher than the long-term average of 16. Back home in India, the market cap to GDP ratio is around 110 against the long-term average of 77. And the forward P, FY 21-22, forward P is around 22, again against the long-term average of 16. So if you look at the fundamental matrices of valuation, the markets are no doubt overvalued. So when there is overvaluation, a correction is due, a correction can happen, a correction should happen ideally, but corrections are not happening. Corrections are not happening even at the global level because the triggers for a normal correction are not there. Normally, triggers for a correction come from the central banks, particularly the Fed or the European Central Bank, turning hawkish because of rising inflation. Bond yields rising in anticipation of aggressive monetary policy, hawkish monetary policy, or some signals indicating the beginning of a recession. These triggers for a correction, a hawkish central bank, rising bond yields, and signals of a recession, all these are conspicuous by their absence. That's why markets are resilient. Markets are surprisingly stable and resilient. So under such circumstances, what should be the investment strategy? It makes sense to remain invested in a bull market because bull markets can surprise on the upside. We have seen this during the period 2003 to 2007 end, when the markets surprised almost all the experts, all the bulls. So it makes sense to remain invested. Particularly, it is advisable to remain invested in performing sectors like IT, pharma, metals, cement, realty, FMCG, automobile ancillaries, automobiles generally, leading financials. In all these segments, there is earnings visibility. Therefore, it makes sense to remain invested in these segments. But investments in mid and small caps should be ideally done through SIPs and mutual funds because there is froth in mid and small caps. So SIPs can continue in the large caps as well as in the mid caps. Mid caps, particularly SIPs in mutual funds, is the desirable investment route. It is desirable to book some profits because we never know when an unexpected negative trigger will break out. There can be a Minsky moment, a totally unexpected event, a black swan event which nobody can foresee right now. So as a measure of abundant caution, it is important to book some profits and move some money from stocks to fixed income, even though fixed income returns are low. Thank you.